So, Ridham, a large primary market sucking out capital, but domestic staying true to the fore, and that capital likely continuing. Is that the base case? You made it a few years ago. It's panned out very well. Does it continue?
Yeah.
Part two of my question: what about the Goras?
See, the domestic investors are going to continue investing, okay, because of many changes that have been put into place. We created an acronym called DREAM, which stands for demographics, real rates, and policy changes and education. So a lot of things have changed. The household balance sheet accrues about $700 billion of saving at the current GDP rate. And if you look at last month's number, you're still annualizing at about 50-60 billion. So you've not even reached 10% of that number, right? The lowest amongst the developed world in terms of household saving into equities is Japan at 12. And Japan, by the way, is now back to equities. Okay, so they are coming back in a big way. European balance sheets have more than 50% in stocks. US balance sheets, household balance sheets have more than 40% in stocks. So we are nowhere close. So this has got many miles to travel. In fact, I am speculating that the government may even allow retirement funds to invest more. So today they are capped at 15% of incremental. The experience has been awesome in the last 9 years. This was allowed by the Prime Minister in 2015. So it's now been almost a decade. And I think the retirees are going to be quite happy because they're getting better and better returns even though interest rates are lower. The Provident Fund is able to deliver because of equity markets. And it makes sense for a long-term fund manager like the Provident Fund to be invested in equities. That's what happened in the US when President Reagan allowed 401k plans to invest in stocks. There, it ended with the NASDAQ bubble in about 20 years. Here, I think it will run a little longer. Our people don't age like they did in America for a long time. So I dare say another 20, 30 years to go. So that's on domestic flows. Now see, in the market, and I say this and I get tired of saying this, there are only two cohorts, right? There are domestics and there are foreigners. If you look at last month's clip, they were putting about $200 million a day into the market. So imagine if domestic funds decide that they don't want to buy for 5 days. It's $1 billion now to invest. You don't do for 2 weeks and you have $2 billion, right? It's a lot of money. And therefore, they have to come every day to buy stocks. Somebody has to sell. So foreigners are selling. Now this will change when the corporate issuer is in the game. So once primary issuances pick up, and therefore you now have the third cohort in the market and a fresh seller, you will find, ironically, the foreigner will come to buy. So if you ask me for a prediction, next 6 months, foreigners are going to buy India.
Okay, and I'm just tying this in because we have 5 minutes left with the investor conference.
I'll tell you one more thing.
Yeah, please, okay.
So yesterday, 3 days ago, somebody asked me this question, a client of ours, that, currently if you look at the emerging market funds, foreign investors are about 50 basis points underweight India. So India has a 17% index weight and foreign investments may be around 16.5. So the question was, how much money does it take for foreigners to go another 100 basis points higher? So slightly overweight from their underweight. And the answer is $50 billion US.
Oh God.
Okay. And the problem is that the maximum that they've ever put to work in a single year is 35.
Okay.
So now you are stuck because this is amongst the best performing markets in the world. You're underweight and you're struggling to deliver performance. And to go overweight, the amount of money that you need to put is just not feasible. The market cannot take that much.